So I'll walk through the difference of indemnity, which is traditional, as you can see from the slide, insurance, and parametric, which is index. Now, the first one is the trigger. What makes it pay, right? The policy. In terms of traditional insurance, is the loss or damage to physical assets. That means you really must see a damage. For example, a car. You need to see that its bumper was knocked in and all that. You need to see the real damage. Or it's a forest and you need to see the physically burnt asset, right? If there was a fire. As opposed to parametric, it only depends on the event occurrence exceeding the pre-agreed parametric threshold. What does that mean in simple English? It means that, for example, we agree upon a wind speed of 70 kilometers per hour occurring that will knock down all the banana trees in your plantation. And so 70 kilometers per hour, if recorded by the weather station, that would actually be the pre-agreed parametric threshold, which means it hits 70 or is above 70, we pay out. Okay, so it is different from traditional, where you really need to see the damage. Of course, in this case, when you're talking about parametric, there is damage because we have already done our research to know that at 70, the trees will be knocked down, right? Recovery. Now, recovery is based on actual loss sustained, right? So if you did have $2 million loss and the assessor goes in, right? Then you'll be written down, okay, fine, this is the amount we need to pay you. It's all in the policy. Now, but for parametric, it's different, right? It is based on pre-agreed. Say, okay, fine. Okay, if it's knocked down, it'll be paid 10 million, 5 million. So there is a big difference here because for the traditional one, it cannot be a situation that you say, look, my assets are market value-wise 2 million, but I want it to be 5. It cannot work under the traditional insurance cover. But for the parametric cover, yes, it can work that way. You can actually agree on a figure. So there will be no situation of over-insurance or under-insurance, right? Now, basis risk. Now, traditional insurance, of course, basis risk, what does it mean? It means the situation where the event happens, but payment is not coming, right? Payout doesn't happen. For the traditional insurance, this could potentially happen depending on how your policy wording was written, right? What were your exclusions? Whether these exclusions were well understood by the client. Now, for the index one, it will also mean that in the event, for example, 70 kilometers per hour, we are saying that the banana trees will all be knocked down. But what happens at 65 kilometers per hour, all the trees were knocked down? We don't pay, right? Because we signed on to agree at 70 kilometers per hour, we pay. So a lot of work needs to be done to make sure that there is no mismatch, that there's a proper understanding that 75 is the correct figure to pick, or 70 is a good figure to pick, rather than 65, right? So we need to do correlation work in order to make sure that the event that happens fits with the payout. So work needs to be done to reduce basis risk, which I'll get into in the next slide. Loss assessment. Now, loss assessment for, let's say, a forest fire using traditional insurance take months to do. You go down, you see how were the trees burnt, you'll see which trees are salvageable, you'll see which part of the tree was burnt, so on and so forth, right? And if it's a large area, it's even more taxing. It takes months to actually sort out how much was burnt, whether this was burnt on purpose, this was burnt on accident, so on and so forth. So the loss assessment takes a long period of time. Now, for parametric index-based insurance, it takes usually, almost 1-2 weeks. The moment the data comes out, the third-party data we agree to use, soon after that, within 3 to 4 weeks, the check goes out. Now, it's very clean, it's very fast, right? As compared to, let's say, traditional kind of insurance. Now, traditional insurance usually are annual, talking about the term, right? Annual, 1 year, maybe 2 years or 3 years, right? But for parametric or index insurance, right, it can be also similar. It can be multi-year sometimes, but it can also be short. It can be 6 months. It can be 3 months. It can be 4 months. So you can be catered specifically for the risk period of the client, right? So it's a little bit different. It's a bit more flexible, a little bit more agile in terms of the way we can structure the term. So that's where actually parametric has a little bit more advantage, right? Now, the structure for traditional insurance is pretty much standard. It's like standard wording, standard contracts, maybe a little bit of changes depending on the location, but that's it, right? For parametric or index, there's a lot of customization, right? We need to know a lot more information because there is nobody that's going to check finally, or when the trigger happens, when the typhoon hits, right? Nobody's going to check.